Hello everyone and welcome to SFC Markets and Finance. Today we delve into the latest developments in the US economy, where inflation is now just a whisper away from the Federal Reserve's 2% target. New data from the Commerce Department shows that the PCE price index, the Fed's preferred measure of inflation, rose by 2.1% for the year ending in September, down from 2.3% in August, marking the lowest level in 3.5 years. Meanwhile, US GDP grew by 2.8% in the third quarter of 2024, following a 3% expansion in the second quarter. The labor market also remains strong, with 254,000 jobs added in September, according to the Bureau of Labor Statistics. As the presidential election and the Fed's next meeting approach, we're joined by Dean Baker, co-founder and senior economist at the Center for Economic and Policy Research. Dean will help us decode these developments and explore what they could mean for the road ahead. Dean, thank you for being with us.
Sure, glad to do it.
Let's begin with the recent GDP data. The US economy grew by 2.8% in the third quarter, which did not meet expectations. What factors held back growth, and what were the main drivers?
Well, there are two things that were the main factors. So most of us were looking for being a bit over 3, so it wasn't a huge miss. 2.8% is pretty strong growth for the United States, so it wasn't a huge miss. But there were two factors easily identifiable. One was that the trade deficit expanded, and that subtracted a bit more than a half percentage point from growth in the quarter. The other factor was we had a slower rate of inventory accumulation. So we were still accumulating inventories, but a slower rate than in the second quarter. And that subtracted about 0.2 of a percentage point from growth. So one of the categories that many of us look at is final demand for domestic products. So it removes trade and removes inventories. And that was 3.5%, which is very solid, quite strong, in fact, by anyone's reckoning. So insofar as it was a miss on the low side, it was for reasons that were easily explained. Now, in terms of what were the strongest factors, consumption was the biggest driver by far. I mean, consumption is most of our economy. It's about 70%. So that was the biggest factor, and particularly durable goods, that there was a big jump in car sales in the quarter. So that was a big factor. Services grew at a healthy rate, about 2.5%. That's about what we expect. So it wasn't extremely fast, but it was, healthy pace. And again, that's what you'd like to see. Investment was growing about 3.5%. A little slower than it had been. We had a shuffle there. We've had very, very strong growth in structure investment, a big surge in factory construction. That slowed a lot. That wasn't going to continue. I mean, we're at high levels, but we weren't going to see continued growth in that, or certainly not at the rate we had been seeing. So structure investment slowed a lot. In fact, I think it actually fell a little bit. And equipment investment picked up and filled the gap. So on the whole, it's looking at a very, very strong economy, seeing good investment growth, good consumption growth. The trade deficit, we're growing faster than our trading partners. That's basically the story there, which, that's the world. I mean, it'd be nice if our trading partners, China's growing more rapidly, but Europe isn't, if they were growing more rapidly, but that's the world. So it was really by almost any, at least by my reckoning, I'll just say a very good picture.
Turning to inflation, the latest PCE figures give us some new insights. What trends are you seeing, and where do you expect inflation to head next?
Well, we're seeing really exactly what the Fed wanted, that inflation continues to slow towards the 2% target. It was 2.1 year over year. The European Central Bank sees 2% as a ceiling. Jerome Powell, he sees it as an average. And 2.1, presumably some point will be below 2, but I can't imagine they're worried that it's 2.1. Now the core number is a little bit higher. So the core, you pull out food, you pull out energy, it was 2.7 year over year. But there were factors there that have held that up. So specifically, our rental inflation has been a really big factor holding up inflation. And this is a measurement issue. So the way we measure our rents, we're taking all rental units, and most people don't move every year. So a lot of people have leases for a year, 2 years, 3 years. They locked in rent increases when they signed a lease, say in 2022, when the market was much tighter. We have separate indexes that measure units that change hands. So when people move and they move into, and those show a much lower rate of rental inflation. So we know that the overall rental inflation is going to converge on the new units. So that's going to bring us very close to 2%. So I think most of the people who look at the inflation data closely are confident we're moving back down to 2%. And
the labor market also remains resilient, with strong job creation reported. Do you see this as a sign of optimism in the job market? And does it help ease concerns about a potential economic recession?
yeah, so there had been a lot of concerns about a recession because we have the Somm rule. An economist who used to be at the Fed, Claudia Somm, came up with it, where if we saw an increase in the unemployment rate by more than half a percentage point, then we're going to see a recession. We see an increase in the unemployment rate by more than half a percentage point, bottomed out at 3.4 last year in April. We peaked at 4.3 back in July. So that had a lot of people concerned. Now, since then, the unemployment rate fell in August, fell again in September. But I don't see a recession in the offing. It looks like the labor market's continuing strong. And for what it's worth, Claudia Somm has said that herself. So she said, look, this is a rule of thumb. It's not some law of nature or anything. And I don't see any basis for thinking we're about to get a recession.
Which sectors would you say are currently showing the strongest job growth? And what factors are driving this trend?
Well, consistently, the strongest job growth has been in healthcare, and kind of obvious reasons. We're an aging nation. We're seeing increased demand for healthcare, and that sector has dominated job growth. There have been some months where it's been close to half of private sector job growth. Other big factors, the construction continues to be, to my surprise, really, a very strong job creator, 25, 30,000 a month, which when we're creating 150, 180,000, it's a good chunk of that. So that continues to be a very strong sector. The other one is restaurants. People have more money, they go out to eat more. So those are the strongest sectors. Manufacturing had been stronger earlier in the recovery, but it's pretty much leveled off. In fact, it's been dropping a little bit recently. So, I don't think it's going to fall in a big way, but in any case, it's not a strong sector any longer.
Looking ahead, what major trends do you foresee in the U.S. labor market?
Again, the election will be a big big source of uncertainty. But one thing we know for certain, we have our huge baby boom cohort. These were people born after World War II. They're retirement age now, so they're retiring in very large numbers. So that's going to continue. If you just took sort of native-born population, basically we wouldn't have any labor force growth. The growth is entirely from immigrants. And of course, we had this big wave of immigration. It's a big issue in our election, of course, that allowed for the rapid job growth that we saw in 2022, 2023. So going forward, a lot of what we see in the labor market is going to depend on the pace of immigration. That's slowed sharply, again, by policy. That's going to mean slower growth in labor force, in jobs and labor force. Another factor is going to be productivity growth. We've had very strong productivity growth. If you take the decade before the pandemic, it averaged about 1% a year. That's a huge, huge difference. Over a decade, it translates 10%. A little, I'm being rough here, but translates into 10% more GDP. It also can mean 10% more wage growth. So that makes a huge difference if we can sustain that rate of productivity growth. And everything we see indicates it is continuing. So if that happens, it's going to be a story, where workers will see higher wages. So when we got into the 80s, 90s, the first decade of this century, most of the wage growth went to the top end. The last few years, particularly since the pandemic, where we've had a tight labor market, we've seen good wage growth at the bottom. And I think if we can continue a tight labor market, continue low unemployment, that will continue to be the case. And, to my mind, that's a really good story. So those are the main things I look to.
With this recent economic updates, what moves do you expect from the Fed in its November and December meetings?
I'd be surprised if they don't lower rates a quarter point in their November meeting. I think, obviously Chair Powell's been very much saying, well, we're going to look at the data. I don't think they've seen anything that would discourage them from lowering it another quarter point. December, if I had to pencil in something now, I'd say he'll lower it another quarter point, but we'll get more data between now and then. And if the data for November looks like the data that we just saw for September and October, ends up being moderate, I think he'll again, so I think we're on a downward path. I mean, we're not going to get anywhere like where we were before. Well, certainly not during the pandemic, but even before the pandemic, somewhere around 2%. And I don't think we'll get that low, but it wouldn't surprise me if we get down a little above 3 in the next, he's not going to rush to it, but maybe in the next year.
How do you evaluate the Fed's approach so far in balancing interest rates to manage inflation while also supporting economic growth?
Well, you can always look back and say, oh, did they do it perfectly? And of course, they never do. So on the one hand, I could say this is really good. It's a really good story. So if you just gave me the numbers, here's what inflation is today, here's what the unemployment rate is today. Are you unhappy? Do you think they really messed up? It'd be hard for me to complain. On the other hand, did they have to raise rates as much as they did? I would say he didn't have to do it as much. So he had 3/4 point interest rate hikes, so 75 basis points. And those struck me as a lot. So if you had done 50 basis points, a half percentage point, I think we could have done what needed to be done in terms of slowing inflation. So I think he went further than was need be. And I think he could have begun to lower rates, say in June, certainly July, but he could have, at least one meeting earlier, and I think very safely 2 meetings earlier, and there would have been no risk of inflation. So I think he went higher for longer than was necessary. But again, we could always say in hindsight, yeah, you could have done it differently. I can't, if I'm Jerome Powell, I'm probably feeling pretty good right now that he did the right thing. One thing I'll just mention, with the Fed, because it doesn't get enough attention, I think, in terms of Fed policy. So when I was saying before, I wouldn't have raised rates as much as Powell did. It wasn't because of its impact on the labor market, because it wasn't, it definitely slowed job creation, definitely, so it definitely had that impact. But my main concern there is really the housing market. So we saw our mortgage rates, they were down, at 3% in fact, lower than 3% during the pandemic, the 30-year mortgage, which are pretty much our standard. It got to almost 8%. I think the peak might have even been over 8% back last year. It's fallen down, but it's still, somewhere, it's gone up a little bit recently, but it had fallen to around 6%. But if you had lower rates, it would have helped the housing market a lot, which again, I'm not thinking so much from the standpoint of employment. It would have an impact there, but it's more just, this is people's lives. I mean, people want to move. You have a lot of people that didn't move because they couldn't sell their house. They couldn't buy a new one. First-time home buyers had a hard time. So that's the biggest reason why I was saying I wish he hadn't raised rates as much as he did. It wasn't because of the labor market. It was primarily because of the housing market.
Given the current economic indicators, would you say a soft landing is within reach for the economy?
I'd say we had the landing. We have inflation that's basically at the Fed's target. I mean, the big issue, as I mentioned, was rents, and those are going down. I mean, it's really baked in. So, we know the rental indexes are going to move towards the market index. Again, I could say I'd rather the unemployment rate be 2 or 3/10 of a percentage point lower. I think that would be good. But historically, a 4.1% unemployment rate, that's really good. I mean, we all talk about in the late 90s, we had 3 or 4 really good years. The unemployment rate only briefly got as low as 4%. So 4.1 isn't much to complain about. So again, I could say I'd like to see a little bit lower unemployment rate, but it's hard to get too upset at 4.1.
Now, as the presidential election approaches, what impact do you anticipate it will have on market dynamics and investor behavior? Are there specific sectors likely to be affected more than others?
It's a good question. If Harris were to win, I think we'd see lower interest rates very quickly. So one of the things that, I and others have noticed is that the long-term interest rates have ticked up, and a lot of that is an inflation premium. And I don't think that they think Harris is about to cause inflation, because basically we're going to see largely a continuation of Biden's policies. I mean, she's indicated ways in which she'll change them, but not in a big way. So I don't think that would have a big impact on interest rates. On the other hand, Trump, again, this gets very hard because none of us really know what he's going to do. So he says he's going to have big tariffs. Will he do that? he says all over the place. So if he does those big tariffs, we're going to have a lot of inflation, and that's going to push up interest rates. That will be a big change. Also, he's proposing his big tax cuts. Would he get those through? Hard to say. A lot of them, these are campaign promises, so he said, we're going to make tips tax free. It's kind of crazy, but he says, we want to make tips tax free. Then he said, we want to make overtime tax free. He had a few other things like that they don't make a lot of sense. Would he actually do them? I don't know. But if he did do them, we'd probably see a much higher budget deficit. So would that lead to higher interest rates? The reaction of the Fed would probably be, oh, if we're going to have a much higher budget deficit, then we should push interest rates higher. Long and short, I think we would see higher inflation, higher interest rates if Donald Trump were in the White House. As far as what sectors, it gets very hard. I mean, ostensibly, he's saying that he wants to have high tariffs to promote our manufacturing industry. So it's easy to say, oh, well, that will help manufacturing. Except, manufacturing is very integrated with the world economy. So we don't have a manufacturing industry that's entirely dependent on domestic production. So they're importing, parts from China, parts from Europe. So if they suddenly have to pay much higher prices for those parts, I don't know that helps manufacturing. He does say he wants to increase military spending. So you could say, okay, well, that will be good for the defense industry. How much he'd end up doing that, I don't really know. So it's very hard to predict what sort of policies he actually would pursue if he got in the White House.
Given these election-driven changes, what general advice would you offer to investors navigating potential shifts in the landscape?
Again, I think people will be reasonably comfortable if Harris wins, so there wouldn't be big changes. Just because she's, people would perceive her, and I would do this, and I think it's a reasonable assumption that to a large extent it would be a continuation of Biden policies, and could disagree, agree with them, but you know what they are. If Trump were to get in, it really would create a chaotic situation. So I think everyone will be trying to guess, is he going to impose these tariffs? Which tariffs? Because again, he's not even been very specific. He says 10%, 20%, and then he wants to do 60% on China. Is he actually going to do this? And then he throws out higher numbers sometimes. So I think it'll be hard. People will be trying to figure out what parts of what he said he will actually do. So I think you will see a lot of erratic movements in the markets as people try to parse, what's coming out from his administration, what he's saying, or what, his Treasury Secretary's top advisors are saying. Because at this point, I don't think anyone can tell you what he will actually try to do.
Finally, as we consider the possibility of a new administration, what potential shifts in trade policies can we expect? And how might this impact the U.S. and global markets?
Well, I would suggest very much being somewhat hedged. Our stock market has gone through the roof this year. It surprised me. It surprised probably just about everyone. I would suggest hedging some. I mein, no reason, it certainly can go higher, but it is very high right now. And, I think there's a lot of risk there. Just even if, again, I think it's more risk with Trump just because we don't know what policies he'll pursue. But even with Harris, it's already very high. So I would very much suggest hedging bets. If you have a lot of money in the U.S. market, to put some of it in, probably diversify it in other countries, what I'd say.
Finally, as we consider the possibility of a new administration, what potential shifts in trade policies can we expect? And how might this impact the U.S. and global markets?
If Harris gets in, I don't think we'll see big changes in policy. And in fact, again, this might be wishful thinking on my part, but there's kind of been an attitude where we need to be hostile to China as like an end in itself. Obviously, there are differences both on trade and policy more generally between the U.S. and China, but I would hope that there'd be an effort to try to negotiate and reduce tensions rather than increase them. Whether she'll do that or not, I don't know. I could say before the election, she wasn't going to do that because, that's the politics. But after the election, there might be an opportunity, a window where they could take a different tact with China. We don't have big conflicts with Europe, with Japan, with Canada. We have trade deals with them. They have very low tariffs on imports from the U.S. There'll always be some issues here and there, so I don't mean to say that everything's totally harmonious, but they're really small scale. Harris, I think, largely more of the same. Again, my hope, and it may just be my hope, nothing based in reality, that we would try to ratchet down tensions with China. but otherwise pretty much stays same. With Trump, obviously it'll be more conflictual how far he carries his tariff plans. I really have no idea, just because I really don't understand what the motivation is.
Thank you, Dean. As Dean pointed out, inflation is now very close to the Fed's 2% target. The slowdown in the PCE index suggests that the Fed's policies are having an impact. Dean also highlighted the resilience of the U.S. labor market, with sustained growth in sectors like healthcare and construction helping to ease recession concerns. Looking ahead, Dean shared a cautiously optimistic view on the Fed's approach. He anticipates that we may see a gradual reduction in interest rates, aiming to support economic stability while keeping inflation in check. As the election approaches, Dean expects increased market volatility, with potential policy shifts from a new administration likely affecting trade dynamics and investor sentiment. That's all for today's show. Thank you for watching. See you.